Listen, I want to be blunt with you. Most people are panicking that the recession will spread to 2026, but now a small group of investors are accumulating huge wealth through thousands of years of gold assets. Stop before you think it is some get-rich-quick plan or precious metals pitch. It is about understanding the macroeconomy, the market cycle, and making real profits while everyone else can't sleep. Here is what we're covering today: the specific movements of gold during the recession, the strategies that worked in 2026, and the mistakes that cost ordinary investors millions of dollars. Stay, because it changes everything. As of April 2026, gold is currently trading at about $4,700 an ounce. That was not the case earlier this year. As early as January, gold touched $5,419 and then fell 14% to $4,660 in 3 days in early February. This move separates people who know what they are doing from traders who panic and sell at the worst. JPMorgan is not shy about where it thinks it will go. Their research calls for gold to move toward $5,000 an ounce by the fourth quarter of 2026, with a real chance of reaching $6,000 in the long run. This is the noise of institutional money, not the speculation of retail investors. Why is this important? Understand why profitable investors are different from investors who simply want to make profits. Central banks and international buyers are already shifting capital to gold, and structural demand has created subsequent prices. When JPMorgan put those numbers on the table, they were not speculating that they were reading what their biggest clients were doing. The economic backdrop is indeed precarious. S&P Global Analysis believes that the risk of recession in the United States in the next 12 months is 30%, but other forecast models show a 49% probability of recession. Consumer sentiment speaks for itself. 65% of Americans now expect a recession in the next 12 months, up from 59% a few months ago, according to a survey in March 2026. This is not speculation. The data show that when recession fears are so deep, geopolitical uncertainty persists and central banks manipulate monetary policy with extreme caution, gold becomes the asset that every smart investor ultimately wants to own. Not because of emotions, but because of fundamentals. Gold has no maturity date. It cannot go bankrupt. It does not depend on fluctuations in corporate earnings or government policies. Our current financial system was valuable before it existed, and when people were afraid, they sought safety. We don't count on psychology, but on basic human behavior consistent with hard economics. That is the mistake that most casual investors make. They think gold is rising in a downturn because it is always rising, which is a reckless idea. It accurately separates the rich from ordinary investors. When governments and central banks feel the pressure of recession, currency depreciation bears the brunt. They have become aggressive on monetary stimulus. Print more money. That means more dollars chasing the same goods, historically weakening the value of currencies. A weaker dollar makes gold more attractive to international buyers because dollar-denominated assets become less attractive when the currency itself loses purchasing power. Gold is insurance against currency dilution. Risk aversion describes what happens next. In normal economic times, investors chase yields and growth, which makes stocks and corporate bonds look attractive. Fears of a recession have upended that calculation. Gold fits perfectly with the idea of taking money out of risky assets and storing it in a safe place. During panic selling, stocks move together, but gold does not. It has nothing to do with the stock market, which means it will move forward at its own pace. That is valuable in a downturn when the stock market plunges 20%, 30%, or even 40%. Negative real interest rate growth creates another driving force that Wall Street understands, but most retail investors completely ignore it. When inflation is higher than interest rates, if you only hold cash or bonds with a yield of 4% and an inflation rate of 5%, your money will lose its purchasing power. The gold rate is 0, and no interest is paid. But when inflation-adjusted real interest rates are negative, holding something with 0 returns becomes attractive because replacing bonds or savings accounts will actually deplete your wealth. Central banks are accumulating gold at a pace not seen in decades. From 2025 to 2026, the major central banks of China, India, and Russia were actively buying gold from their reserves. When institutional buyers with almost unlimited capital start accumulating assets, there is structural demand that allows retail investors to take advantage. Geopolitical turmoil ended the situation. Gold has historically soared during periods of geopolitical tension and trade uncertainty. When investors are worried about international conflicts or sanctions, the flow of funds to gold is tight, and geopolitical risks remain high in 2026. So when you see gold prices rising, you're not observing some arbitrary random behavior in the precious metals market. What you see is the collective risk assessment of the world's smartest capital allocators. Gold moves are not random, but in response to the real situation. At present, these conditions make gold continue to rise until the end of 2026. Let's talk about real money, not theory, because understanding how wealth is compounded with gold is where things get interesting. Start with a conservative approach. Imagine that when gold was trading at $4,500 an ounce, you invested $50,000 and got about 11.1 ounces of gold. Today, at $4,700 an ounce, the position will be worth $52,170. The 4.3% gain didn't sound impressive until you realize that it outperformed the S&P 500 over the same period because of market volatility. Your gold position has just stabilized and risen, while everyone else is selling stocks in panic. This requires zero active management and zero pressure. Now, let's introduce the strategies under different configurations. Instead of buying $50,000 in physical gold, buy $50,000 worth of gold ETFs, especially GLDs or ISEs, which trade similar to common shares. This allows you to get in and out without friction. Use the rest of the money to hold calculated positions in gold mining companies that actually mine and refine gold. Mining stocks typically magnify the trend of gold, sometimes 2 times to 3 times in the direction of gold prices, which allows you to obtain enlarged returns through the stock market without the risk of margin calls. Here are the calculations. Allocate $30,000 to gold ETF and $20,000 to gold ETF. As of the fourth quarter of 2026, gold prices rose from $4,700 an ounce to $5,300, an increase of about 12.7%. Your $30,000 gold position becomes $33,810, a gain of $3,810. Your $20,000 mining position, if mining stocks move gold percentage 25 times, yields 31.75%, equivalent to a yield of $6,350. Total return? Deployment $50,000, $10,160. That was 20.3% in 8 months, compared with an annual average of 9 to 10% for the S&P 500. You'll see twice as much return and less volatility because you're positioned correctly. Sophisticated investors are now reaping handsome returns here, in part because they understand margin and capital discipline. Gold futures contracts allow you to control large positions with relatively little money. One contract controls 100 ounces of gold, about $470,000 at current prices. You only need about $10,000 to $15,000 in margin to control your position. Suppose you put $30,000 in futures margin to control 300 ounces of gold. From $4,700 to $5,300 an ounce, equivalent to a gain of $600 an ounce, or $180,000 on your 300-ounce position. That is $30,000, 600%. It is life-changing money. Unless you really understand margin risk, I don't recommend it, because futures can expand rapidly, but that is how institutional investors actually build positions during recessions. They understand the increased exposure and strategically determine the timing of imports and exports. The potential for wealth accumulation is not a simple rise in gold, but to understand where you are when gold moves and how to intelligently magnify it. So you actually want exposure. which means understanding every realistic approach from the safest to the most radical. Physical gold represents the easiest way to buy coins or bars directly. Walk into a coin store or order from a reputable dealer like APMEX or Golden Eagle and take physical possession. It is all yours. The upside is physical ownership outside the financial system, which is important if you're really worried about a systemic collapse. But ownership comes with real costs. Storage costs money. Insurance costs money. It is not liquid, and you can't sell like a stock right away. Transaction costs are brutal, usually 5 to 10% higher than spot prices, buying and losing 5 to 10% when selling. In terms of friction alone, this is a 10 to 20% round trip cost. Unless you expect big swings in gold, this friction kills your earnings even before you start. Accumulating wealth during a recession is too expensive. For most investors who accumulate wealth in the economic cycle, the gold ETF represents my preferred method. ETFs like GLD or IO trade on stock exchanges, exactly like ordinary shares. You can buy through a standard brokerage account. That is, the advantages accumulate quickly. The current position can be sold immediately. The cost rate is only 0.17 minus 0.25% per year. The tax efficiency is high. The monthly investment is easy to automate, and the barriers to entry are low. You don't own physical gold, which means you own gold held by a fund, not the metal itself. In a real financial collapse, everything institutions say is worth it. But if the financial system collapses completely, millions of people face worse problems than gold investors. This is the best choice for most people. Gold mining stocks performed differently. Companies like Barrick Gold and Newmont Corporation, or ETFs in industries like GDX, have provided some strength in the gold rally. Mining companies doubled their profits and gold prices. If a company has $5 million in operating costs and the price of gold allows them to withdraw $15 million in assets, that is $10 million in profit. Doubling the price of gold would give them a value of $25 million, which would mean a profit of $20 million. An increase of 100% just because commodity prices rose by 100%. When gold rises, mining stocks are harder to rise, usually 2 to 3 times taller than gold. The expanded yields have attracted investors who are satisfied with stock risk and want greater exposure to gold, but mining companies bear operational risks that pure gold exposure does not. Geopolitical mining disruptions, environmental regulations, or corporate inefficiencies can hurt mining returns, even if gold prices remain stable. During the 2008 financial crisis, mining stocks fell 40 to 50%, and gold positions were relatively stable, indicating operational risks. Gold futures provide direct exposure through commodity markets. The contract controls the price exposure and maximum amplification of 100 ounces of pure gold. While these require margin accounts, the risk of daily settlement and clearing increases if the action is against you. This is a truly dangerous area for professional investors. Gold royalties and streaming companies represent complex positioning. Franco-Nevada and Royal Gold do not mine gold themselves. Instead, they finance mining projects and account for a portion of future gold production, essentially owning mortgages for the gold mine rather than the mine itself. These companies benefit from rising gold prices, have no operational mining risks, and can generate stable cash flow to pay dividends even when gold prices are flat, creating less volatility than mining stocks. For a 35 to 60-year-old investor who amassed wealth during the recession, the optimal allocation is 60% of the gold ETF is used to stabilize and clean up exposure. 30% of the gold ETF is used to amplify earnings. And 10% of royalties or streaming companies are used to diversify and dividend income. This gives you upside while dispersing operational and company-specific risks. Most investors are insatiable here and will soon lose money. They understand that gold should rise, so they go all out right away. This is gambling, not strategy. For those who don't have the perfect time, the dollar-cost averaging method is the most reliable. Regardless of the price, you invest a fixed amount each month. Commit to buying gold ETFs at a price of $1,000 a month in the next 12 months. and on the 15th of each month, regardless of the rise or fall of gold on that day. You're buying systematically, not chasing the top. That is because these math formulas are good for you. When gold hits $4,700, your $1,000 buys about 0.213 ounces. When the price fell to $4,500, the same $1,000 bought 0.22 ounces, slightly more. When the price rises to $5,000, you buy less. Over time, you buy at an average price that is usually below the peak and above the bottom, capturing most of the trend without accurately calculating the reversal time. Within 12 months, $12,000 was deployed at prices ranging from $4,500 to $5,200, with an average cost base of about $4,850. If gold closes at $5,200 negative $5,500, you will see a 10 to 13% increase, which is not flashy, but a reliable accumulation of wealth, more than almost all other options. Dip buying requires more market attention, but it works if you regularly monitor prices. Reserve 30 to 40% of the allocation funds for cash, and wait for opportunities. Observe the gold price. Whenever it falls 5 to 7% from its recent high, this is a signal that you deploy 30 to 40% dry powder to buy down. Most of the pullbacks in the bull market resume within days or weeks, which means you buy at temporarily depressed prices, knowing that the rebound will resume. For a total of $50,000, immediately deploy $15,000 to build positions at current prices, holding $35,000 in cash, waiting for a correction. When gold falls 5 to 7%, buy another $15,000. If it falls another 5-7%, the remaining $20,000 will be deployed. This ensures that you never miss the start of the rebound and get a better price in each callback. Recession signaling methods need to focus on official recession confirmation. 2 consecutive quarters of negative GDP growth technically defined the recession. When this news is announced, it is the trigger for you to deploy your largest capital. Why? Gold's gains have been hardest at a time when officially confirmed recessions often lead to large flows of money flowing safely. In April 2026, the risk of recession was already 30 to 49%. So if these probabilities were formally translated into the actually reported recession, it would be your green light. It is an honest fact, though it is really hard to try perfect timing gold. Most investors should use the average dollar cost as their main strategy because it removes sentiment from the equation. Billionaire investors aren't the ones who perfectly timed gold. They recognize that gold is undervalued relative to the risk of recession, systematically invest in capital, resist panic selling during callbacks, and hold positions during rallies. This discipline trumps perfect timing every time. I've completely covered the upside. Now, we need to talk about what destroyed most gold positions. Excessive leverage destroys accounts faster than anything else. Yes, futures can generate 500 to 600% returns, but they can also easily generate 500% losses. Margin is two-way, and most retail investors who used it during the recession were fully liquidated. Don't be them. Maintain the margin at the 3-to-1 ceiling. That is, control the maximum gold exposure of $30,000 for every $10,000 actually held. This gives you room to make mistakes without being erased. Panic selling during volatility creates more wealth than doom. Gold will fall. February data showed that we fell 14% in 3 days. Many investors saw this, thought they were wrong, and sold at the bottom. Classic and costly mistakes. A pullback is a buying opportunity, not an exit signal, unless your core thesis really changes and won't change because recession fears remain high. The high transaction costs of physical gold destroy small gains. Friction alone costs 5 to 10% of the round trip cost. Gold needs wild swings to break even on these costs. That makes sense, only if you expect gold to reach $6,000 or more. Otherwise, stick with 5-year to 10-year ETFs, because you actually keep your earnings. Diversification within gold is more important than most investors realize. Don't put all your money into ETFs or mining stocks. Promote it to gold ETFs, mining ETFs, and perhaps streaming companies. One failure won't ruin your entire position. Failing to exit the program before buying represents another major mistake. Before you buy anything, know what you're selling. If your note is gold and reaches $5,500 by the fourth quarter of 2026, you buy at $4,700, which is a 17% upside opportunity. But what is your real way out? Do you sell everything for $5,500 or have it? Can you hold on longer? Define this before allocating capital, because emotions can make you hold winners too long or sell them too early. A plan stopped that. Ignoring inflation expectations poses a potential risk. Gold performs best when inflation expectations rise. If the central bank starts to win the fight against inflation, gold will be less attractive. Monthly inflation data. If inflation cools significantly, reduce positions accordingly. Ignoring currency strength is the last common mistake. The strengthening dollar has done significant damage to gold prices. If the dollar rises 10%, gold tends to fall, despite the overall economic weakness. The moves could be sharp and unexpected. Investors who make money from gold do not ignore risks, but actively manage them. Let me link this to a specific timeline of what might happen throughout 2026. Now, the second quarter of 2026 is the time to consolidate. Gold trades between $4,600 and $4,800, and the market assesses the possibility of a recession. Volatility remains high. This is the accumulation stage where you want to buy methodically rather than waiting for the perfect price that may never come. From the third quarter to September 2026, the economic data deteriorated further based on current trends. Unemployment is likely to start rising. Corporate earnings guidance turned cautious. Central banks may signal easing because they will feel pressure to support the economy. Gold rebounded to $5,000 during that period. Mining stocks outperformed the market significantly because they amplified earnings. That is where your patience really paid off in the second quarter. The fourth quarter of 2026 and October-December brought waiting times for most investors. At that time, the risk of recession may be confirmed, or the market is deeply worried that confirmation is coming. Gold enters the $5,000, negative $5,500 range, which may hit JPMorgan Chase expected $5,000 level. That is where you start to profit systematically, not all at once, but carefully. Entering 2027, if the recession officially strikes, gold may continue to move in the direction of $6,000. But your goal is to make profits in the process of rising, not to hope for perfection. Billionaire investors understand the cycle. When everyone is afraid, they buy. When everyone is greedy, they sell. They focus on macro cycles rather than fighting them. Specifically, volatility is expected to intensify further by 2026 as recession fears intensify, and volatility is actually good news for gold investors because it creates both risks and opportunities. The probability of gold closing above $5,200 in 2026 is about 65 to 70%, maybe 30 to 35% of the time, between $4,800 and $5,200. If recession fears subside entirely, the odds of closing below $4,800 could be 5%. That is far more likely for gold investors. The thing about gold and the recession is this: they're neither sexy nor stimulating. They don't make viral videos of getting rich overnight. But they've worked, and they've worked for centuries. People who end up rich aren't waiting for perfection. They see opportunity, plan, execute with discipline, and have the patience to let it work. If you follow the framework I outlined for diversified positions, systematic buying, active risk management, and clear exit plans, you can create real wealth as the recession unfolds. The market will give you a chance. The question is whether you're ready to accept it. See you next time.